Ladies and gentlemen, welcome to the webinar. Today's seminar presentation is the taxation of foreign trusts and the foreign grantor, U.S. estate and gift tax avoidance. Our presenters today are attorneys Gary Forster and Brian Page. If you'd like a copy of the presentation, you can find it in the handout section of the webinar interface. There's also a firm brochure there as well for you. Okay, let me turn it over to our presenters. Gary, Brian, take it away.
Hello, thanks for attending. I'm Gary Forster. I'm here with Brian Page, and we're going to talk today about the foreign trust, and in particular, the foreign grantor. That is, the foreigner who settles the trust, who funds the trust for often himself and other people. The foreign trust raises a number of tax issues, which are very distinct between a U.S. American grantor funding and forming the trust and a non-resident, non-citizen individual funding and forming the trust. Last month we talked about the American funding and forming the foreign trust, and this month we're going to talk about the foreigner and really the non-resident, non-citizen putting assets into a foreign trust, why they would do it, and what the implications are. On the agenda, you can see that we'll go through some generalizations in the introduction. There's some tax considerations in general associated with non-resident, non-alien individuals, of which a foreign trust under most circumstances will be considered a non-resident, non-citizen type individual. We're going to determine whether or not we have a foreign trust. Even if a trust is formed in another jurisdiction offshore, it may not be a foreign trust for IRS purposes. Associated with that, we're going to determine how to calculate taxes associated with the foreign trust, whether it's a grantor trust that is ignored with respect to the founder of the trust. Grantor trusts are basically don't exist for income tax purposes. And then when someone is actually considering becoming a U.S. resident and maybe a U.S. citizen, what options they have to avoid bringing their whole taxable estate into the United States. That's what's in the U.S., assets they own in the U.S., and assets they own everywhere else on earth. A lot of people are under the impression that when they come into the United States that they're only subjecting assets they have inside the United States to tax. That's not the case. Residents and citizens are taxed on all the assets they have in the whole world, and we'll talk about how to avoid some of that through pre-immigration planning. And then we'll also go into some of the details associated with treaties, and how double taxation can be avoided. Brian's a guru at the compliance. We'll talk about what has to be filed for your CPAs on the line, and we go into a small discussion on asset protection. That's really another seminar, but everyone's always interested. Well, okay, if I'm going to form the foreign trust, what am I doing? What have I done in terms of creditor protection? It is significant, so we're going to go into that. At least a summary of that. That includes the asset protection with LLCs, the foreign asset protection trust, and really how to handle them, fund them, treat them to try to get them to try to ensure their effectiveness. Then we go into some issues and some common misconceptions and conclude.
All right, well now just for us to get started, just to give you just an overview, introduction of whom we're talking about and why it's important. But throughout this presentation, I'm going to use the term NRA, which is a non-resident alien, which has a certain meaning under the tax legal code, both for income tax and transfer tax purposes. But speaking on this specific topic, the use of foreign trust, it's important to understand that even if you have a person who is an NRA and they create a foreign trust, if there are U.S. beneficiaries of that trust, there are substantial reporting requirements that have to be met along with the compliance at each year that exceed what would normally be on any domestic trust, inside the United States. So it's important to understand that. And so that's the perspective in which we are going to be talking about here. Also, the taxation of these trusts potentially will arise upon their creation, when they have income, and then when they make distributions to the beneficiaries inside the United States. Obviously, this is all based on facts, and the exposure of the taxation is based on what individual created the trust, what's their status, who is it for, where is the trust located, and then where the bennies are at the time of distribution. So we're going to go over that and understand, but again, it's all based on the facts of the trust. Some basic rules. As we know, the U.S. income tax, which is Subtitle A, is enforced on all U.S. persons on their worldwide income.
And who are U.S. persons?
U.S. persons are those who are citizens or those who are U.S. residents, usually with like a green card, for income taxes. You also can have an individual under the substantial presence test that would, for income taxes, would be a U.S. resident.
So it doesn't have to do that much with intent, income tax. It has to do with how long you're here, whether you have a green card, or of course, if you become a citizen, you're a U.S. person for income tax purposes. And then estate tax is a different standard. Go ahead.
Sure. For the estate tax or any transfer tax, if you're a U.S. resident or citizen, obviously that's easy. If you're here already and you have a green card, for the most part, you are domiciled here. And so with the idea of domicile under Subtitle B, which is the transfer tax code area, based on physical presence and intent to remain, you have to have both. So it's important that there are times when you might have a client that might be a resident for income taxes, but not for estate or gift taxes, or vice versa. So it's important to understand that the tests are different depending on where you are, Subtitle A or B. At times they intersect, at times they diverge, and it's important to understand all the facts to get there, because it will affect greatly an NRA, especially if they have worldwide assets and that are substantial.
Yeah, and oftentimes if someone's an income tax resident, for instance, and they don't intend to stay here, well, they're not a U.S. person for estate tax purposes, or vice versa. In other words, maybe someone's not an income tax resident, they're not here for a certain number of days, but their intent is to move here and stay here permanently. There's pitfalls to both situations, but also if we can narrow down exactly what the intentions are for each of the individuals, there's often some huge planning opportunities as well, because of the two differing standards for taxation. But it is something to keep in mind as we get through we have quite a few slides. Well, I'm not sure we'll get through all the material in the 50 minutes. But as we get through it, you'll see that the two standards really are viewed completely independently, except in the case of what we're going to talk about with some of the aspects of the foreign trust.
And then as for non-U.S. persons, or in this case, either an NRA or a foreign trust, we have some special income tax rules that apply. And basically, it all depends on the source of the income. Now, there are exceptions to the source rule, which we have listed here. The main one are stock sales with the sale of intangibles. We have treaties, obviously it will affect income tax. We have the 30% withholding on passive income. We have the graduated rates for the ECI, or effectively connected income, which is basically with a trade or business inside the United States. And obviously with foreign trust, there are some special rules If it's a respected non-grantor foreign trust, there's no tax to the foreign trust if there's no ECI or U.S. real estate gains.
Well, that's right. And the foreign trust, if it's not disregarded, and we'll talk about how it may be disregarded for income tax purposes, is really treated like a foreigner, like a non-resident individual. Some of these things, amazingly, even people coming in and out of the country worth hundreds of millions of dollars are unaware of the fact that they can be a non-resident for income tax purposes and sell their IBM stock at no capital gains. There's no capital gains applicable to them. A lot of people don't take advantage of treaties where they can avoid double taxation. Sometimes it's a difficult calculation for the CPAs out there, because sometimes you can use a treaty, sometimes you can use a foreign tax credit. It just depends upon what's best for you. I mean, you're going to use the most beneficial tax avoidance strategy. The 30% withholding really comes in for the non-capital sales, for sale of non-capital assets, whereas U.S. people or residents, we're under a graduated income tax regime. We also get deductions. Under the 30% tax rule in general, there's no deductions. You're taxed at 30% on the gross passive income. And as a sideline, that's true for the business. The business, you get the deduction, that graduated rates for effectively connected income there. The exception for sale of stock does not apply if the sale is of a U.S. company that holds majority real estate. That comes under the FIRPTA regime and is an exception to the exception. This stuff gets kind of complicated, but the idea is a foreigner can sell stock and there's no tax unless it's a real estate company.
Right. And it's just important to note that if you do have a foreign non-grantor foreign trust for income tax purposes, that the U.S. bennies are only taxed on the income when it becomes available to them through a distribution. Just to keep that in mind when they receive a K-1 of income and its income. Since they're U.S. residents, they would have to report the income on their income tax return. Now, for the estate tax or Title B, there are also very unique rules for non-U.S. persons, and that's because of the nature of how we impose the U.S. transfer tax. But the simple rule is that it's imposed on U.S. situs assets. And that's really what the rule is. And there are ways to plan to where maybe for income taxes, it's taxed one way, but for a state, it's another. And through the planning of, of how it's owned. And for instance, the sale of an intangible during their lifetime, as we saw before for an NRA of a U.S. stock in a business, is not taxable in capital gains wise. But if the NRA dies owning the stock, that's part of their U.S. estate. So it's important to understand that you have these different regimes and how they interact, and through planning, you can avoid these things. And just to note, unlike a U.S. resident, an NRA, their credit is only $60,000. That's it.
Yeah, it's a very significant need to plan for non-residents who have substantial assets in the U.S. And fortunately, planning is very available. There are a number of planning strategies that typically can eliminate or substantially eliminate the estate tax for a non-resident alien.
And then, there are some treaties out there that may affect the estate tax. And again, that's going to be based on the facts, depending on the country in which they might also have assets.
Well, sometimes it depends where they have the assets. Sometimes if someone is a resident of the U.S. and a citizen of a European or other related treaty country, they may fall under what's known as a Domicile Treaty. And domicile, basically what happens is domicile is attributed to you through the treaty. So let's say, for instance, you have assets in the U.S., you may have income in the U.S., but you're a French citizen. France has a treaty with the United States. It's I'll just overgeneralize, but that says, okay, if you're a citizen of one of the two countries, then you're attributed with the domicile of that country. So the domicile country is the only one that can tax, which creates interesting opportunities. So if, for instance, someone's a resident in the US but considered domicile in France, and France is the only jurisdiction that can tax and doesn't impose the capital gains tax or something like that, it's simply not imposed. It's an interesting, you can play with these treaties such that they deem certain status to domiciliaries, citizenship, or on another format, they would have a situs treaty, which taxes based upon where the particular assets are. It all becomes very complicated, and it's usually not a complete solution because there's exceptions for where you have businesses. But a lot of times you can find loopholes in these treaties that allow for tremendous tax savings.
Now, the income taxation of a non-grantor foreign trust, there's a basic income tax rule. And again, they're basically treated like a NRA or a non-resident alien as regards the trust is as a person. Now they do have certain like limitations on credits and certain deductions that are unique to trust, but that is the general rule. So again, if you have U.S. source income for a foreign non-grantor trust, the foreign non-grantor trust is going to recognize that U.S. income. And as we spoke before, what that means, basically, it's income derived from sources within the U.S., and then you have the ECI income that are effectively with a trade or business. That's, again.
That's generally it.
Right, for a foreign trust. So these are some examples of where the foreign trust would recognize U.S. source income, the disposition of U.S. real property, as we said, the effectively connected income of a trade or business, or FDAPI, which are fixed or determinable annual or periodic income.
So if the trust owns property in the U.S. and receives a rental payment, a monthly fixed payment, that's FDAPI. That's subject to the 30% withholding tax. Similar would be interest. Now there's exceptions for certain promissory notes which exclude interest, which are pretty prevalent. But let's say that is a FDAPI source. So interest, maybe a consistent dividend, this kind of fixed and determinable passive stuff is subject to the 30% tax.
Just gives you an overview of the difference between the taxation of an individual or a trust. As you can see, a trust has a compressed marginal rate compared to an individual. So you're at the marginal rate at $12,750.
You're at the highest rate.
Highest rate. So I mean, there's been a policy choice by Congress that if you have income inside a trust, you're going to pay more income tax because we want you to distribute it out to the individual. That's why it's done that way. Now, that's income tax. Now, as regards transfer tax, a lot of these rules are the same. The treatment of an NRA of when they make gifts to things. But as we spoke before, a NRA is only subject to U.S. transfer tax if the asset is in the United States, the situs of the asset.
So the foreign trust, if it qualifies as foreign, which we'll get to in a second, is basically taxed like a foreigner So a non-citizen, non-resident is only taxed by the U.S. The U.S. would probably tax everyone on earth, but there's really no way to tax a citizen of another country who lives in another country on assets outside the country. Otherwise, they probably do it. So you basically, as a non-citizen, non-resident, the IRS only taxes U.S.-based assets, either based on a fixed and determinable income. You can have wages, all this kind of thing for individuals. For trusts, it's basically FDAPI or sale of real estate.
So one strategy to get around this is to purchase U.S. cited assets in a foreign corporation.
Well, on the estate side, if in fact, let's take an individual non-resident, non-citizen. Basically, we never understand why people come in. We're in Florida, so we have a lot of these issues come up constantly. Why people come in and, for instance, purchase a large home or some major asset in the United States with respect to the estate tax. Because if in fact you purchase, let's say it's a big, we just had one where someone purchased a huge mansion, husband and wife. They were given no guidance. They sought no guidance either, but they were given no guidance. So what happened, so now they've got this real estate in the US in their own name, and there's no spousal deduction. So what happens is wife died. The mansion's worth $4 million. And so she literally has a $2 million estate tax, $2 million estate and an $800,000 estate tax bill due immediately. And all that they had to do on the initial acquisition of the property was to buy it in a foreign entity taxed as a C corporation. They would have bought in a foreign entity taxed as a C corporation. It doesn't die. So when one of the owners dies, the nexus between the United States IRS and the individual was broken by the foreign corporation. So there would have been no tax due. So on the estate tax, the gift tax, those are called transfer taxes, every time a foreign person, almost every time a foreign person comes in and wants to acquire a significant asset, it should be done, if they intend to remain non-resident alien, it should be done a foreign entity tax as a corporation.
Now, we just need to go over some basic definitions here as defined in the code. What is a foreign trust? A foreign trust is actually, it's a negation of if something's not a domestic trust. And under the tax code, a domestic U.S. trust must meet two tests. Must meet the court test, which means that a U.S. court has the authority to bind the trust administration. And two, the control test is you're a U.S. trustee. If you have those two tests and they're both met, then the trust is a domestic one. If it fails either or both of those tests, it's a foreign trust. That's the definition. So you might have a trust at one time that is a U.S. domestic trust. It's important. And if a trustee dies and the successor is a NRA, potentially, if nothing's done, the trust would convert from a domestic trust to a foreign trust.
Yeah, so you could actually have a Florida or let's say Delaware, whatever you're using, trust, and let's say it's a first generation group that came in, formed this trust with a lot of assets, and the backup trustee is Uncle Nels. So Uncle Nels, the trustee withdraws or dies or whatever happens, Uncle Nels is automatically becomes trustee. He's non-resident alien. He's living in Sweden or whatever. And so you now have a foreign trust. People say, well, okay, I'll just fix it. Well, it's complicated. It's complicated because now with the foreign trust, you've slipped into all of the compliance and taxation of a foreign individual, number one, and then all of the compliance and taxation of a foreign trust, which you have to unwind at that point. So it's kind of significant. I found when you have a first generation family coming in that you be real cognizant of these successor trustees. You know, what's interesting, Brian, about this classification, there's also occasionally an opportunity to plan with respect to something remaining a foreign trust.
Sure.
So if you have a group moving into the U.S. and it's not that common, but they have a foreign trust and they want it to remain classified as a foreign trust and not a U.S. trust, it's easy to do it. You just retain the foreign trustee, even if you convert the foreign trust because they're now American, they're more comfortable with having a Delaware trust to Delaware. So you can actually have a U.S. situs trust, but it's considered foreign for IRS purposes.
Absolutely. Now, it's important to understand why a foreign individual, an NRA, would want to have a foreign trust be a foreign grantor trust. Obviously, the tax laws in their home state or their nation probably will be different than in the United States, and the idea being that they would pay the income tax themselves, if any, and that any distribution to a U.S. Benny would be income tax free. That is the idea behind having a foreign grantor trust for the NRA. And of course, the IRS doesn't like that.
Well, what happened was, like in I want to say the late 70s, and early 80s, is people picked up on the idea that they could move to a different country from, let's say, a country that doesn't tax you based upon your worldwide assets. You know, so they moved from Panama, which I understand taxes only based upon assets held in Panama, for instance. They say, you know what? I'm going to move to a jurisdiction with a very low tax rate. I'm going to go to Ireland for a while to take advantage of a new discounted rate. Or I'm going to go to Portugal, which has a tax holiday for 5 years. So they don't have to pay income tax for 5 years. So they become Portuguese, for instance, residents. They're not subject to income tax. And they say, you know what? I'm going to move $100 million into this foreign trust, and I have a lot of U.S. assets, and I'm gonna kind of deflect the tax. I should say U.S. beneficiaries. So I have a lot of foreign assets, but U.S. beneficiaries, and I'm going to call this trust grantor. What we mean by calling this trust grantor is that it's ignored for income tax purposes. So it's just like that Portuguese-based grantor, it's him owning all of the assets, even though there's a U.S. beneficiary. So he pays all the tax, which is nothing, and the income goes back out to the U.S. beneficiaries tax-free. That was kind of a circumvented thing. I apologize for that. But our whole practice in this area is a little complicated. But the idea is there was a loophole, which Brian's going to explain. It's been pretty much closed up.
Right.
But the idea sometimes is to retain some control over these trusts, which causes them to be taxed to the grantor individually and not the beneficiaries.
So we have a related question. So there's a question from William. If there's a husband and wife and both own property in their own names separately and filed taxes separately, do the estate taxes become $120,000 non-taxable?
I'm sorry. So the individuals.
Yeah, they still get
Husband and wife.
Yeah. Each individual NRA gets a $60,000 credit against the U.S. estate tax.
But it doesn't amount to much if the assets are significant.
Well, yeah, I mean,
it's it amounts, that's the exemption. It's actually
Exemption.
not a credit.
Well, right. It's the total.
Yeah, it's
right.
like it's 20,000 or something.
Yeah.
You got to do the math, but it amounts to very little tax savings when you're talking about significant assets.
Like a home, especially, especially if it's real estate in the United States owned by an NRA, they die.
Yeah.
I mean, it's
It's 60,000. What we meant by the exemption is that's not the tax.
No.
That's the value not taxed. It's almost nothing. And the issue, which is just a tragedy when it occurs, is it's so easy to avoid with foreign entity.
And again, just as a comparison, a U.S. resident or citizen receives under current law an $11.4 million exemption.
Yeah.
So I mean, that's a substantial difference for wealth and other reasons and why it's important. Going back to the grantor status for a foreign trust, in response, the Congress passed Section 672F, which basically limits the ability of an NRA to create a foreign grantor trust for U.S. income tax purposes with U.S. bennies. That was done in 95.
With it substantially limits it.
Right, substantially limits it. So now there are only three possibilities to where you still can get the foreign grantor trust status. And I've listed them there. Obviously, if it's a revocable trust, for the NRA, they say that it would be grantor. If the grantor or his or her spouse is the sole benny of the trust during the lifetime of the person who makes the trust, it works. Or if it was created before 1995. That's it.
So in these scenarios, the grantor is viewed as owning trust assets, and that all income, for income tax purposes, and that all income will be attributed to the grantor, who can play the game of being in a income tax jurisdiction with a lower rate than the U.S., even if there are U.S. beneficiaries. It's very limited, but it's an interesting plan.
And so one strategy, as Gary just said, would be to use one of these exceptions under 672F and have it to where the grantor would recognize the income, if any, and any distribution to a U.S. benny would be tax-free, income tax-free.
Yeah, this was standard operating practice until this 679 was put in place.
So, okay. Now, why is this important? Well, based on all these rules now, if you have an NRA who wants to immigrate to the United States, there are a lot of planning opportunities before they actually get their green card. But it's very, again, the rules are very stringent, and you have to make sure you do it the correct way. Like number one is any gift of a foreign asset by an NRA that's not in the United States is gift tax free.
Sure.
So if they want to, they can give those things away. A lot of times they don't want to do that, but that's an option. The other option is to create a foreign trust that names themselves and their family members as a beneficiary.
And then there's a weighting requirement that Brian's going to go to.
So in response to this, Congress said, okay, you can make a transfer for transfer taxes purposes into a foreign trust, and we'll accept that and respect that. However, under the income tax rules, they decided that if the NRA does not wait 5 years before establishing the trust and then coming to the U.S., they're going to deem that NRA to have transferred all the assets on the date of us receiving their status in the United States on that date as a gift to a foreign trust, which means under 684, it would be a deemed mark-to-market sale. of all the assets inside the trust.
If in fact the person comes in and the assets contributed to the trust are not part of the person's U.S. estate, which was the idea. So if someone gave away the assets before they came in, to eliminate the estate tax on the assets, they're now in the trust. He's done with the estate tax, but you have to be very careful with this 5-year rule, because now when you come in, there's a regime that's similar to what's called the exit tax. So what they're trying to do is they're going to say, okay, now that you've come in, we're going to say, no, you didn't really eliminate those assets from your estate. You were just playing games. So now, okay, we'll accept the fact that we're not going to be subject to the estate tax. But what you really did was you came in and then you expatriated those assets offshore. So we're gonna treat you as if you put those assets into the trust after you became a U.S. person, and that triggers the exit tax for trust, the deemed sale of all of those assets. It's a complete disaster. We're dealing with a few clients. You really have to deal with on the law side and the accounting side with people who understand this stuff, because what happens is people, they'll either they won't plan at all, or they'll do the estate side, but then they'll enter within the 5 years, which pretty much throws all the planning away, because they're deemed to sell. They have to suffer all the capital gains worldwide if in fact they come in and the trust is in place.
And what's even worse is they create this foreign trust, they come within the 5-year time period, and then they have a U.S. Benny of the foreign trust. Then it becomes a grantor trust for them during their lifetime. And you might think, oh, that's great, but it's actually not, because when they die, all the appreciated assets will then meet the mark-to-market on death, which is even worse. So again, you have to make sure that if they do this type of planning, they're very methodical and understand what the rules are. Okay, this is interesting.
Oh yeah, treaties, sure. I was making a note there. So we had touched on treaties, and treaties are a hugely impactful factor in international tax planning. Treaties come in two types. There's situs treaties, and there are domicile treaties. The situs treaties are less popular now because they're so complicated and have so many exceptions, but basically say that the taxation will be by the country where the asset is, the situs, the location of the asset. So these work pretty well with respect to like real estate and tangible assets. Where they fall down, and I think the reason why they've lost a lot of popularity, is that the situs of an asset is defined somewhere, right? So where's it defined? Well, the U.S., for instance, defines the situs of corporate stock as where the company is located. So you've got a lot of Delaware public corporations. That's the situs, right? For estate tax purposes, someone could give that away, but if they die with it, there's U.S. estate tax. But a lot of countries say, no, the situs of a corporation is where the certificates are, right? So if our same Frenchman, dies with a stock in a U.S. entity, the U.S. is going to say, no, that stock is a U.S. situs, and France is going to say, well, I'm just making this up, but France will if they're situs based, will say, no, that stock is in France. So now all the rules related to crediting someone for tax paid abroad, or just allowing one country to tax a particular asset, a situs asset, don't really work, because there's a dispute as to where the situs of the asset is. So if the U.S. says it's in the U.S., the U.S. taxes it. France says it's in France, France taxes it, and the U.S. won't accept the French definition of situs. that's a little overview on the frustration associated with situs treatise, but the idea is situs treatises work based upon where the asset is, and domicile treatises basically say the country where domicile is established gets to tax the individual. The other country has to hold off basically on taxation. It's more simple, it's more straightforward. It's still complicated because there are exceptions for the situs of sometimes real estate, the situs of a business, but the treaties in general eliminate the taxation by both countries.
Okay.
Oh, this is the fun part.
This is the part you all have been waiting for if you're an accountant, the compliance. So what does all this mean? Well, if you have a U.S. Benny of a foreign trust, the U.S. Benny has to file a Form 3520 every year with the IRS with their 1040 individual tax return. And that's true even if they do not receive income from the trust in that year. It's a informational reporting requirement they must do every year. And so make sure that they're doing that. If not, make sure that you amend the returns and make sure the IRS knows. Also, you potentially might have some FATCA issues. Again, that's going to be fact-based. Just make sure that if they meet the thresholds, that those are being reported.
What is FATCA, Brian?
Well, there was a regime of reporting that was issued by the IRS a few years ago to where if you have certain foreign financial assets, they are reportable each year to Treasury, so they know you have them out there. Mm-hmm. And depending on the status of the individual, if they're married or not, where they reside, there are different thresholds. If you have assets, foreign assets over the threshold, mm-hmm. you're required to file a form to ID where they are.
And let's compare that to the F-bar.
F-bar is a little different because the threshold is much, much lower.
That's for the accounts.
Right, that's for just the financial accounts. And again, that's from FinCEN. That's not an IRS form. It's from, the Financial Crimes Enforcement Network. And again, they're very aggressive on this, but if the aggregate value of a foreign account exceeds $10,000 at any time in a taxable year, a U.S. resident has to report it to FinCEN.
Or citizen.
Citizen, yes.
Yeah.
Yes.
Yeah, even if you're abroad and you're living abroad and you're a U.S. citizen and you open these small accounts, you're liable to report this. We've had a number of these come up, and when the account's small enough, you can pretty much assure your client that they're going to just have to walk away from the account because the penalties and interests are so onerous that it's just basically it should not apply to these small accounts, but it does. And it's just basically impossible for the clients to even grasp that this is in place, but it is.
Now, if you have a NRA who creates a foreign trust and it's respected and it's okay, if they come in within the 5-year period and it's then a deemed contribution by a U.S. resident to a foreign trust, at that point, that U.S. resident at that time will be required to form a 3520 each year because they're considered a U.S. owner of a foreign trust.
And if the foreign trust has an account, is that a FATCA or a FAR
Yes.
issue?
Yes, it is.
Yes, it is. Okay, great. I didn't even know that. So you learn something every day.
Compliance is great. It's all about, and again, just also too, the foreign trustee will also do a 3520A. I don't talk about it here, but there is a owner statement and a beneficiary statement that is required to be sent out on March the 15th of each year. If it fails to happen, the U.S. owner, deemed owner, is responsible.
Yes. So the 3520 is the main compliance form for foreign trust, and it's basically a multi-party form that allows for very easy matching. basically they have to get every piece. If they don't have every piece, then they know it's not complete, from the bennies, from the trustee, from all of the different parties to the form. And it's pretty comprehensive. And the software's good, but you've got to really work through that 3520 if you're involved with foreign trust.
And the penalties for not filing these informational returns, that's all that they are.
Yeah.
Are draconian. So make sure that you ask the right questions and you have the info to get the forms done.
So on asset protection, we figured we'd stick a little bit of this in there because it is foreign trust, and most of the trusts that come up with respect to domestic clients are at least partially for asset protection purposes. Asset protection involves these circumstances we have here. That's titling. Obviously, we deal with a lot of husband and wife titling in Florida, which prevents any creditor of either husband and wife from reaching assets. If it's only against husband and wife, we can buy exempt assets here that can never be reached by creditors. And then we have LLCs and of course the trusts, and we today went through the taxation of the foreign trust. What's amazing about the foreign trust is, the foreign trust was created really in the 70s and 80s to create a jurisdiction outside of which U.S. courts can act. So basically, if you are subject to a creditor in the U.S., the judge basically enforcing that judgment, if you lose the judgment, doesn't have jurisdiction over the foreign trust or the foreign trustee. And if you place assets outside the country, no jurisdiction over the assets as well. This has to be done in a prudent manner. There can't be any issues going on when you fund these trusts, but they're extremely protective. So successful were they that later in the 90s, Alaska, then Delaware, and now 16 states offer this kind of trust you can fund for yourself, which is protected in those states. We're now in the middle of the pretty substantial line of cases, which is defining when and under what circumstances a domestic asset protection trust is enforceable, but generally the nexus to that jurisdiction, that being if you use Nevada, we like Nevada, South Dakota, you have to use a Nevada trustee. You really likely have to place assets in that jurisdiction and have some kind of connection to that jurisdiction. That's kind of the basics on asset protection. I know we're about 5 minutes over. We didn't know if anyone else had any questions. We had a couple more slides. We threw in some material for you on LLCs and their protections. If they're not as protective as a trust, an LLC basically can be liened. One means of avoiding the lien is to hold husband and wife. Then in order to get the lien, in general, if tenancy by the entirety is established, would be to have a judgment against both husband and wife. So the creditor would need to sue both husband and wife, win a judgment to get to an LLC in general. This is the charging order, the lien that can be made on an LLC. You have to be careful to pick the right jurisdiction so that the charging order can't be foreclosed and you can't lose your equity in an LLC. Several jurisdictions now are very protective of the LLC. You have to be careful with having a single member. Certain jurisdictions allow for foreclosure of the equity. For a single member LLC, privacy is a concern. Delaware is very good because there's no public disclosure of any information. And of course, offshore is the most protective, most private. There's an example here. We were involved with Nevis a lot of the Nevis LLC. Nevis also offers a very protective trust. Here's the single member LLC, some material, and some of the factors in weighing whether you want to form a foreign or domestic trust. We added some cases which we don't have time for, but they basically go through some of the factors on how you have to create a real connection to a domestic asset protection trust for it to be enforceable, how to select the right trustee, And here's your connections, the people, the assets. Don't go bankrupt. That's become a tremendous
Number
problem.
one.
We're not really here to hide assets. And I just wanted to make sure I got my picture into the presentation. I'm on the left. And that wraps up our presentation, I think. Tony, thanks so much. If you need us, our contact information is at the bottom of the last slide. We are a corporate tax and international boutique firm in the Orlando area, servicing pretty much all of Florida and the U.S. Thanks so much for listening today.